Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall. I'm Eric Auskerson, one of your hosts for today. With me is Lisa Simpson. Lisa, it's great to be with you. Another summer has almost passed.
I'm still trying to figure out what happened, but it's great to be back. I missed our town hall community, and we've got a lot to talk about today.
We sure do. We've got a power hour ahead, so I hope the town hall community has had some time off. It's Thursday before Labor Day, and we have plenty to discuss. So let's take a look at the agenda, Lisa. We're going to kick things off with an economic forecast with Marcy Russell, someone that the town hall community has heard from before. Just a very timely update as we head into the fall season. Then we have Mark Peterson joining us for the latest on what's going on in Washington, D.C. And even though Congress is in recess, there's plenty going on. And Lisa, I know you've got a number of sections as well.
Yeah, I'm going to do a technical update and going to throw in a little bit of non-tax technical. So that's going to be fun. And I've got some good news for our CPA exam candidates that I want to share as well. And then I'm excited to welcome back Sarah Ferentz and Stan Sterna to talk about professional liability risk management tips that they have for us. So it's part of our ongoing conversations with them. And I know I always learn so much when they're joining us.
And we've got thousands attending, and we'll have a lot of questions coming in that you and I will try to sift through for the open forum. So I guess, Lisa, let's get started, and we're gonna bring up Marcy Russell. Welcome, Marcy. It's great to have you. Great to see you again here on the town hall. Just a little bit of background about Marcy. She's the former chief economist for CNBC, co-host of Squawk Box, someone who's really provided a lot of insights to us as we were navigating through the pandemic, the huge growth after the pandemic. So we've had a lot of sessions with you. So welcome, Marcy.
Pleasure to be here. Thank you so much, Eric.
So we've got a number of topics. I got a lot of questions for Marcy. So this is what we're going to be covering over the next 15 minutes. And before we kind of get into this bucket list, what I want to start off with you, and we can drop this slide, is what I want to start off with you, Marcy, is just a little bit of a look back. You've been with us, pretty much since we started these town halls 4 years ago. And what a remarkable 4 years it's been. The shutdown of the economy, then the huge growth, and then discussions on the supply chain, labor markets. Now we're into, kind of really getting out of this inflation window. But when you look at the U.S. economy, and you and I were talking about this before earlier today, and you look at the dynamic nature of the U.S. economy, one thing that I was mentioning to you is like the huge role that these trusted advisors have played. Maybe just some perspective on, we haven't hit a recession. We just have had 4 years of growth. So how do you see all of this?
Well, it is absolutely shocking how well the U.S. economy recovered from the COVID-19 shock. When you and I were talking maybe 2 years ago, and the Federal Reserve was just getting ready to start to raise rates, everybody was expecting a recession. Everyone was expecting mass layoffs. And I got to tell you, that just didn't happen. And one of the reasons it didn't happen is the ability of American businesses to basically adjust to economic conditions so much faster than their counterparts in other parts of the world. So one of the sort of things we have going for us is sort of relative to Europe, say, the U.S. economy is slightly less regulated. So it doesn't feel that way to small business owners sometimes, but if you read the New York Times, Nicholas Kristof himself had an article just this morning talking about the threat to Europe's growth that is coming from an overregulated economy. So during the pandemic in the US, rather than choosing to support the link between businesses and their employees, basically keeping everybody employed in the same place, in the US, we supported businesses, we supported employees, but we did that independently. And it allowed for this great rearrangement of economic activity because it's U.S. businesses with the help of their trusted advisors who are on this call right now, that were really so flexible in the moment and could adjust to the situation. And it's one of the reasons why the US economy has recovered and managed to withstand rising rates much better than other countries around the world.
Because, I mean, the UK had a recession. There was recessions in Europe,
Yep.
New Zealand, Japan. So right now we've done our best to avoid this recession. Let's talk about the rates. I mean, everyone's looking. There's a lot of big dates coming up in September, September 18th, the next Fed meeting. So where are we with inflation, and what's your outlook on rates?
Well, this is the moment the world has been waiting for, where central banks around the world, which had been raising rates for the past 2 years to fight the highest inflation since the 1980s, are now poised to bring rates down. So the Swiss central bank moved in June. We saw the European central bank move in June. We saw the New Zealand central bank, since we mentioned New Zealand, they actually lowered rates in August, and the US Federal Reserve is set to lower rates in September. And it's all because monetary conditions, labor markets, inflation, GDP, they've all gone back to what I will call the pre-pandemic normal. So supply chains are back to normal. Labor markets, again, we sort of manage that soft landing. I don't like that cliche, but I'm going to use it because everybody knows what I mean. And so the Federal Reserve is sitting here just like on the edge, getting ready to lower rates because, as Jerome Powell said in his remarks at Jackson Hole, it's time. And the economic indicators suggest indeed it is time.
So where do you think the rate cuts are going to be? I mean, and this rate cut, and what do you see over the next 6 months?
I expect the Federal Reserve to move cautiously. So remember that markets right now are sort of 50-50 on the fence. Will it be a 25 basis point cut or a 50 basis point cut? But I was an economist at the Federal Reserve in my much younger days of my career, and they are a cautious bunch, and they only cut rates aggressively in a crisis situation. Well, we don't have a crisis going on here. We are normalizing monetary policy, and they are dreadfully afraid of making a mistake at this point. And the mistake would be to cut rates too aggressively, inflation flare back up, and then 2-3 months down the road, they have to undo it. And that's why I think they'll cut rates by 25 basis points. Then you'll get another basis point cut, 25 basis points after the election, and then maybe another 2 next year, where you'll see short-term rates even out at about 4.5%, which gives you a mortgage rate somewhere around 6%, a prime loan rate somewhere around 6% as well.
Yeah, and you're already seeing mortgage rates right now at 6.5. So just talking about rates, I mean, there's raising rates in Japan, so we got lowering rates here. What does this mean? I mean, what does this mean for the global and domestic markets?
It sure meant a lot last month. So countries around the world are moving to lower rates with one exception, and that is Japan. They're the only major central bank around the world that's actually moving to raise rates because they finally are seeing, after, 40 years, inflation is beginning to pick up there. So they surprised global markets earlier this month with a rate increase while the rest of the world was loosening rates, which meant that carry trade that had been so profitable for so many years, where if you're a hedge fund manager, you borrow money in Japan at a really low interest rate, and then you take that money and you go over to Brazil or Mexico and you invest it at a very high rate of return, and you just make money on the spread. Well, when Japan unexpectedly raised rates, the currency strengthened, interest rates are higher there now, and it sucked that trade's profitability out. And so investors around the globe were moving to unwind very quickly. You saw tremendous turmoil in financial markets. You saw it in Japan with the Nikkei falling very dramatically. You saw it in U.S. technology stocks where we saw the S&P 500 lose 400 basis points in about 400 points in 3 weeks worth of time. $6.4 trillion knocked off of market capitalization worldwide. All because everyone was scrambling to undo the carry trade, which is why financial markets have bounced back so very quickly, because it wasn't really about recession fears. It's about something kind of technical in financial markets.
Yeah, the market just seems to keep on going up. So maybe moving to the labor markets, it's something that the firms think a lot about. Clearly, you're hearing that people are more concerned about their jobs. It's taking a little bit longer for people to find jobs. What are you seeing from the data? I know there's been some discrepancies in some of the numbers that have been reported.
Well, we did get a number earlier this month, revisions to the Bureau of Labor Statistics employment numbers that come out month over month. And every year they revise those numbers. And this year there was a big revision down where the economy basically grew labor markets. There was job creation. It just was a lot less than what everyone thought it was. But I want to be clear. There were no job losses last year. It's just there wasn't as much job growth as everyone expected. And I suspect that this audience sort of knew that already. You know that talent, while not easy to find, is probably easier to find than it was, say, 3 years ago. So certainly the numbers suggest that labor markets are looser than they were before. Your experience probably suggests that it's a little easier to find talent. But I would not say by any stretch of the imagination that there's a surplus of labor, a surplus of talent out there. And again, your own personal experience of the economy will reaffirm that point of view. So essentially, labor markets have gotten weaker, but remember, they're weakening from the tightest labor markets we've seen actually in my entire lifetime.
Well, there was an article today in the Wall Street Journal about some businesses looking to do, salary corrections, trying to lower, maybe it got too frothy, both in the white collar market and the blue collar market, trying to adjust down. What do you think that's a real trend?
I think it's very difficult. One of the things that we know looking at economic data is that economists say that wages experience stickiness to the downside. So it's a little easier to correct wages in the US than it is, say, in Europe. But unlike other prices in the economy, which can go up and go down and go up and go down, wages frequently go up, but it's very hard to get employees to accept lower wages.
And Marcy, do we have a technical issue there right now? Just ask the studio. Do we have a... Well, I think we have lost the feed to Marcy. She froze. Okay, give us 1 minute and see if or not 1 minute, give us a few seconds here. I can look at some of the questions and we can see if we can get Marcy back live with us. We do have a few other great questions to ask her. And we can also move to our DC update and then just bring Marcy in at the conclusion of that. And that probably makes sense. So why don't we bring Mark Peterson up? Mark, you're there.
Hey, Eric.
And the connectivity in Washington, D.C. right now is good.
Everything's working
great. It's good to see you, Mark. So Mark, busy times. I mean, every year you've got plenty of material.
I know.
But you've got let's get right into it.
Sure.
I hear we've got a presidential election. We got a debate coming up on September 12th. So the latest.
Yeah, well, Eric, not that I watch it closely, but we're looking at 67 days and 9 hours till the election. In between that, we've got obviously a couple debates, both presidential and vice presidential. And then also remember, depending on the state you're in, there's early voting in many states. And so people will actually be going to the polls before Election Day. So they'll be locking in their votes, potentially even prior to some of the debates. So obviously, Vice President Harris got a big bump coming out of the Democratic convention. and has narrowed the gap with former President Trump. When I use Real Clear Politics, which is an aggregator of polling, kind of give you a sense of where things have headed. And then look at the battleground states in Arizona, Nevada, Wisconsin, Michigan, Pennsylvania, North Carolina, Georgia. It's down to 0.1% if you add up all of those states. And so it's definitely narrow, and we'll see what happens as this plays out.
Well, Mark, I mean, there probably was a late June town hall, and things looked quite different than they do today, and that was 2 months ago, and you've got about 2 months to the election, so things move fast.
Absolutely, they do move fast, and we're going through. Listen, we work with the administration, with Congress, no matter who's in charge, but we do make an assessment of how it will impact our issues, from tax to audit, and then figure out how to approach the priorities that the administration and Congress have in order to position ourselves for success. So we're getting ready for all that, Eric.
Well, if Marcy comes back, one question I was going to ask her is, what did she think from an economic standpoint on who gets elected to the White House? So we'll hold that question, and we'll move into another kind of economic matter here in some ways, a trade economic matter, the FTC non-compete ruling that occurred just a couple weeks ago.
Yeah, it was actually last week. I mean,
last week.
People think nothing happens in August, but obviously we're making some news. Congress is out, but the courts were active. And so there's a federal judge in Texas that actually struck down the FTC's ban, saying that the FTC didn't have the authority. This was a massive rulemaking, extremely broad, probably the broadest in the FTC's history, and a flagship for the FTC. So it being struck down by a federal judge is a significant hit. Now, we've been watching this. We'll continue to watch it. The FTC has not decided, Eric, if they're going to appeal it. I think the quote was something that at this point they're going to take cases, non-compete cases, on a case-by-case basis. So, as it was supposed to go into effect on September 4th, I believe, the FTC, as of right now, does not have the authority to enforce that. And so there's going to be more discussion about that because, the FTC can always appeal, and you never know the outcome. But that's where it stands right now.
Well, I mean, this is pretty significant. I mean, do you think this? How big a surprise was this?
So the court watchers don't think it was a very big surprise. The Biden administration had been very focused on this. I've mentioned before that President Biden had actually talked about non-competes and banning related to lower wage jobs, things like Jimmy John's or Uber. So it was definitely an issue that was profiled by the administration, and it was a significant knock. Now, again, FTC, this was an incredibly broad rulemaking. And so the folks that pay attention to the courts didn't think that it was a stretch. Okay.
Well, Mark, I mean, this is a topic, we've had this slide once, we've had it 100 times on the town hall. It's either, but it's the funding, it's the CR resolution, or it's the debt ceiling. But what we're talking about right now is government funding, not the debt ceiling.
That's right. No, I kind of feel like we could hit record and then we could play it again, because the way government's working these days, whenever we get close to the funding running out, which is at the end of September, we start to talk about how are they going to keep the government open. We do not believe that there's any interest on either side of the aisle to shut down the government heading into an election. But there are a couple different ways that this can play out. They could do a short-term funding bill that gets them past the election. They could do a long-term funding bill that actually gets in, and I'm sorry I'm saying this, but gets them into like the first quarter of next year, which would be right in the middle of tax season. And then they will have to come back to figure out how they're going to fund agencies like the IRS. Speaking of the IRS, so some bills have passed. The government, they don't have all 12 bills done through the House and the Senate and signed. But the bill that actually holds both the IRS and the SEC, a version passed the House, a version passed the Senate, and they're going to reconcile those. In the House bill, Eric, they actually cut $2 billion from the IRS budget for enforcement. They prohibited funds being used by the SEC for ESG. And they also would prohibited FinCEN, one of the sub-departments at Treasury, from promulgating BOI rules, beneficial ownership. Now, again, that was just the House version. So in the end, we think that as they negotiate that out, that the IRS funding will be put back together. The SEC will be funded again at some level. Now, beneficial ownership is still out there as, either a delay or potentially, again, pulling funds. I think of those two, no funds being used versus a delay is more likely, but it's definitely a possibility. So we'll see how this plays out. The other thing I will say is, regardless of the funding issue, we do anticipate a lame duck. A lame duck is an opportunity, maybe potentially, to see some of the tax legislation that we've been talking about for the last year.
And Mark, just so if they did, delay the funding or stop the funding on FinCEN related BOI, what would that, is it clear the ramifications that would have?
It's not clear. I mean, I think that there's a beneficial ownership is a derivative of money laundering legislation and regulation, right? There is bipartisan interest in attacking money laundering. And so there's going to be bipartisan policy interest in trying to resolve this. The issue that we have, which we've discussed many times, is that the small business community, which this is focused on, is not ready. And so and we've actually been having conversations with FinCEN about that and how we can help to get our clients ready in order to have to comply with these information requirements. But it just takes some time. And even, some of the small business associations who poll their members, have 80-90% of their membership that has no idea about these requirements. So there's just a lot of work to get done. Ultimately, I think there's something that's going to happen. And we're encouraging, firms to be doing this work for clients if they so choose, but a little time wouldn't hurt.
So Mark, lame duck coming up. I know we're going to talk about another court case, but any comments leading into the lame duck? And also, I know next week the following week, our next town hall, we'll be talking more about kind of some of our tax thoughts related to the end of the year in 2025.
Absolutely. So 2025 is a tax year for sure.
Right.
What it's going to look like is going to be election dependent. Who's in the administration? What's the makeup of the House and the Senate? But we've got expiring tax provisions. We know that. Lame duck is also election dependent. So, if it's going to be a trifecta, one party wins, the House, Senate, and the administration, the White House, they're going to have a different view of whether they should do something in lame duck, where it's divided government, or they should kick it over into the following year where they control all the strings and levers for Congress. So again, we've got a list of things that we may see related to potentially being considered in a lame duck, but we're going to have to see what the election outcome is. And then, lame duck is interesting because you have people voting during lame duck that maybe have retired, maybe lost their election, maybe lost their primary, a couple months ago. And so it becomes all about, are there enough votes to get something done? Sometimes Congress wants to get both sides of the aisle, just want to get it off their plate going into the new year, and they deal with that. And you mentioned debt limit. Debt limit, I believe it expires in early January. However, Treasury uses what's called extraordinary measures to push that out. So technically, they probably won't have to deal with it until midsummer, but that will be another cliff that's going to create anxiety and force Congress to move.
Okay. And Mark, the elections, obviously, do you think that sometimes plays into lame duck? Just what,
absolutely,
how the feedback, they're on the campaign trail, they're hearing the hot issues, and they see how the voters, go to the polls and, kind of feel about the state of the country.
100%. Absolutely. A lot of it is, it's also, and again, this is not a partisan comment, it's both sides of the aisle. They may not want to deal with controversial funding measures before an election. So they will agree in a bipartisan way they're going to kick funding over into lame duck or at least a medium-term funding legislation. But there's lots of opportunities. I will tell you, historically, through my experience, they start out with a long list, Eric, of to-dos in lame duck, and then it gets narrowed down to the absolute must-pass. Is usually the way it works.
It's gonna be a busy few months, Mark. So you're gonna keep working well past elections. So going on now to another Supreme Court decision that we've been talking about over the past couple of months.
Yeah, this is listen. There's been gridlock in Congress, but the courts sure have been busy, and the Chevron defense is is a big Supreme Court ruling, and we've talked about it at the town halls. We're going to continue to monitor it closely. Basically, in a nutshell, what the court said is that they were going to limit the ability of agencies to interpret legislation if there was ambiguity. So if the legislation wasn't specific, they weren't going to allow the agencies and the regulators to actually make massive interpretations. An example of that would be, if the non-competes, let's say that there's an appeal, it moves forward, they may still address it in Congress to make sure that they can support the outcome they want from the courts. That was a very broad interpretation, and so that would be susceptible to this. It's going to be challenging in two ways. There are rules and regulations that the profession struggles with, and this may be welcome. But I'll also tell you, if you think about tax law that passes and the IRS has to interpret, a judge making rulings is not going to be deferring to the IRS in the same way as they had in the past. So that's going to create some uncertainty. So it's really going to be a mixed bag, I think, for practitioners. I think the uncertainty around implementation after legislation will be greater and last longer. But it also does, on the other hand, create another lever to actually influence the outcome of regulation.
And you think laws now will be written if this stays intact with a lot more specifics in them, because they'll be like, okay, we thought we could rely on our administrator, who we know would kind of follow the direction of this bill, but without that ability, they'll just our bills are going to get longer.
100%. Their congressional staff, both sides of the aisle, are workshopping. They're starting to get ready for how they're going to have to draft things in a new way. I mean, the legislation gave a lot of leeway for interpretation by agencies, every type of legislation, not just the IRS or Treasury, EPA, all the agencies. And so they're going to be doing that. And then there's also, particularly on the Republican side right now, Eric, there is activity going on in working groups where they're looking at each agency and trying to figure out if there is an opportunity to leverage the Chevron decision in order to go and impact regulations that they're not fond of.
All right, Mark. Well, this has been a great update, and we're gonna hit. Marcy is back.
Great.
The connectivity is working in her office. So Marcy, studio. Can you bring Marcy back in? And you can drop the slides. And so good to have you back, Marcy. And
the technical difficulty will follow the technical update. How about that?
There you go. So this is a live show, and we just react and roll with it. So here, you just heard Mark's update, which was great.
Yep.
And so let's talk about the how as people are saying, okay, what does the presidential election mean to the stock market? What does it mean to the labor market? What does it mean to inflation, the economy? So all of the above. Give us some insights.
Absolutely. Well, I have held throughout my entire career that I never give presidents too much credit when things go right, and I never give
Well, that's it. So we'll look into whatever the technical difficulty was there. I'll let you know Marcy's answer to that was that, overall, due to the checks and balances there, it's probably not worth overthinking the presidential election related to the economy. So hopefully, things will continue in a positive fashion no matter who comes into the office in 2025. So with that, let's move on to the technical update section. So Lisa.
Hey,
Welcome,
happy to be
Lisa.
back. Technical updates following technical difficulties. Let's assume that's over and behind us. So thank you, Eric.
Yes.
I do want to start with a quick follow on onto what Mark was just talking about on those Supreme Court decisions. There is a great podcast that we highlighted on that slide. Melanie Lawrenson, who's been on the town hall before, goes into some more detail around the potential impact of those Supreme Court decisions and gives you some really interesting history into those. So I do highly recommend that you take a listen to that if you haven't yet. I know I learned a lot and understood the implications of those different decisions more clearly. So just my little plug for the podcast there. And Eric, you can let me know if you want to switch back to Marcy, if you want me to go with technical.
Oh, no. Okay. I think we are, we're not going to go back and get a third technical strike. We're going to stay with just 2 strikes there.
All right. 2 strikes is safe.
We got plenty of material. So let's go into another hot topic here.
Okay.
Favorite ERC.
Definitely a hot topic. Hopefully you all watched our short update that we provided to you around August 15th, I believe. And just shortly after we released our 20-minute or so hot topic update, we got an announcement from the IRS that they were releasing their second voluntary disclosure program as it relates to employee retention credit. This one is going to run through November 22nd. So you've still got a very short window that you need to work with. And this is for those taxpayers who have submitted claims and now are rethinking it. There are eligibility requirements, so you haven't already gotten the refund or cashed the check, you might be eligible for the voluntary disclosure program. The details are going to give you more information on who's eligible and who's not. But again, the key points from my perspective are that it runs through November 22nd. The taxpayers who take advantage of this are going to be able to repay their ERC claims that they don't want to take now that they've thought more about it, at a 15% discount. They avoid future penalties, interest, and audits related to those claims that they're choosing to withdraw. There is a payment agreement that you can set up if you can't repay the entire amount at the time that you're submitting your withdrawal, and that may have penalties or interest associated with it. So just wanted to call out that particular nuance. This is not, excuse me, if we can go back for just a second, this program is not as generous as the first round. And we knew that that was going to happen, but, we're not getting any indications that there could be another one. So if you have clients in this situation, I'd certainly be talking with them about it. The IRS had sent out about 26,000 disallowance letters, and they just announced that they are going to be sending out another 30,000. They're using an algorithm on the back end to score the risk of the claims that have been submitted based on some analysis they did of a million or so claims. So it could be that some of you or some of your clients are getting disallowance letters that are, in your opinion, not correct. So be on the lookout for that. More letters will be coming after this next 30,000. And I wanted to call your attention to a blog that the National Taxpayer Advocate released it just a week or so ago. And this is about, if you got a notice of denial, now what? What should you be doing? It's a good read. I'd encourage you to take a look at it. And I'll also remind you that we have resources in the resource center that you'll see on the slide there. One quick note as we transition to the next topic, if you download the slides, you're going to see a couple of topics in there that I'm not going to cover today. So this is your quiz or your Easter egg, if you want to think of it that way. Go download those slides because there are a couple of updates we're just not going to have time to get to. So make sure you can catch all of those by downloading the slides. The next hot topic that I want to talk about is another IRS announcement, and this is an updated written information security plan template that they've provided. I'm going to call it a WISP because it's a lot more fun to say. Not nearly as cool as GLAM, but it's still pretty fun. And this is a good resource for you because I know a lot of practitioners, especially smaller firms, struggle with meeting that legal requirement to have a WISP. So the IRS gives you a 28-page template to help you through the process. And then in our tax section resource library, we have some resources for you as well. So please do not forget about your legal requirement and refer to the IRS resources that they've just updated for changes in technology, identity theft, and data breaches. So you've got good information there. And then our next topic is, let's see, I've lost my slide. So hopefully Eric can advance those for me. The next slide is to zig a little bit into the employee benefit plan audit space. And I know that not everyone in our community is going to be doing EBP audits, but you know someone who does. And I thought this was a really interesting warning that came out from our Employee Benefit Plan Audit Quality Center's Executive Committee. So I wanted to bring it to your attention. EBP auditors are being asked to sign third-party agreements, non-disclosure agreements, and confidentiality agreements as they're trying to access information provided by the plan record keeper, the TPA, other service organizations, et cetera. The auditors often have to get through that first acknowledgement to even get access to the data. Our concern is that some of those agreements may compromise or limit the auditor's ability to perform that independent financial statement audit that they're signed up to do. And it could also cause them to violate some professional standards that are already inherent in the work that we do. So it's our position that the auditors have to have that unfettered access. We also have these old standards that we already are required to uphold. And if we sign off on one of these NDAs or confidentiality agreements, we might be violating one of those ethical standards that we have. So as I mentioned, the Employee Benefit Plan Audit Quality Center has been looking at this, and they've given us a resource that I wanted to make sure you knew about. So I've got a link to a letter that they provided on the next slide, and it's got great information for you. It's going to give you examples of when this might be coming into play, what some of the potential consequences are, in addition to what I've just highlighted, and then some recommendations to consider. They're also working with service providers because we know this takes me back to the third-party assurance days. A franchise asking you to verify information, or just a loan officer asking you to verify information. You're getting all of these requests that you cannot comply with. So we educated the providers. Same thing here. We are educating the service providers around why it's not appropriate for them to ask you to sign these NDAs or confidentiality agreements. So they've given our list of encouragements for auditors to think about, and I'm going to let you read through those in your own time. I do want to call out that last one. So again, you may be in a firm where you're not doing audits or you're not doing employee benefit plan audits, but take this into consideration for your entire firm. Does your firm know about this risk, or is this something that you can take back to them? This is just an example of the great work that our Employee Benefit Plan Audit Quality Center does. If you are in that space at all, I would highly encourage you to join the center. Cost effective, and it's been proven that the work of EBP Quality Center members is of a higher quality, as you'd guess from the name. So please make sure that you're checking this out and sharing that with others in your firm if it's not applicable to you. So that's our EBP update. And then I wanted to finish, before we move into our risk discussion, with some good news about the CPA exam. If you recall, the new version of the CPA exam model launched in January of 2024. That new model has basic core sections: audit and accounting, tax, and technology. And then candidates choose one discipline that they want to focus on for their testing. And those three disciplines are tax compliance and planning, business analysis and reporting, or information systems and controls. Because this is a new exam model, there have been delays so that we can make sure that the exam test is psychometrically accurate. I've learned so much in the last 12 years. I now know what psychometric means, but don't quiz me. And so what this means is that basically you have to have a statistically valid number of responses so that we can prove that the model of the test is good. So for the core sections, they are going to now be in a position to launch the cores with continuous testing in 2025. So that means that there's no downtime and that a candidate could retake a failed section in the same calendar quarter. And in that first quarter of 2025, they're going to release 4 batches of data so that we can help your candidates understand where they are in the testing process and move along more quickly. The discipline sections are going to be opened up more rapidly as well. We'll be administering them in the first month. But because there's fewer people taking a discipline, because there are 3 of them, we need to have a valid number of responses in the exam to make sure that it's appropriate. So I know that that's caused some consternation for some of your candidates. This is good news. We're getting into the rhythm, and we'll be getting enough data to speed that up. Last little bit on this one, and then I'll scoot over into risk management. The candidates who are in the process of taking a discipline can take one in June of 25, because we're going to provide another testing opportunity to accommodate a window, an extension window that was given around COVID relief, because so many candidates struggled with prioritizing the exam during COVID. So all good news there. I've given you a link if you want to know more details. And with that, we'll close out the technical update, but move into that professional liability update. And with that, I am honored to bring up Sarah Ferentz with CNA and Dan Sterna with Aon. Again, both regulars on Town Hall, and welcome back to both of you. This is part of a series that we've been holding with our AICPA member insurance program. And in the past, we've been talking about these 5 pillars of risk management practices. So we've already discussed engagement letters, client engagement, and acceptance and continuance, which is important, the value of communication, and now documentation seems a perfect follow-up to that. So Stan and Sarah, welcome back, and let's dig into documentation and why it's so important and what some of the benefits are outside of maintaining that good documentation.
Sure. I'll kick us off, and thanks for having us back again, Lisa. Good to be back. Sitting in this role, advising firms on how they can manage risk, I truly and Stan truly see the benefit of documentation, and we love documentation from a risk management point of view. But if I put my practitioner hat on and remember what it was like when I was in the shoes of so many of our audience, documentation was not my favorite thing to do. And sometimes I had some colorful words for documentation. So while we understand that it is certainly a benefit for risk management purposes and professional liability purposes, you may not share the same love of documentation as we do. So from a business perspective, documentation has so many other benefits. I mean, when you expand your scope of services, when things take longer to perform or deliver a service than maybe you anticipated or budgeted or thought it might when you created your fee estimate, well, that extra documentation of your extra efforts and maybe some client delays or client changes, that may allow you to bill more for those services and unbundle your fee a bit. It definitely helps from a staff training perspective when you have good, robust documentation, especially for annuity engagements where you have a model or an example for those that new staff to follow and to learn from as they go along, delivering that service the next year. And certainly from an efficiency standpoint, that can help too. I mean, we don't want to ever copy what we did last year necessarily without thinking it through and whether or not last year's approach is still relevant for current year risks, but it certainly helps serve as a guide, and you can gain some efficiencies and therefore lower your realization or increase your realization, wrong way. But certainly beyond risk management, which is near and dear to our hearts, it can and certainly provides a lot of great benefits.
So I think what I just heard you say is Sally isn't always the right approach.
Sally is never your friend on an audit unless she is actually a member of your engagement team.
All right, so let's talk about the impact of documentation on a practitioner's risk profile.
Okay, so historically, inadequate documentation is a loss driver of professional liability claims, and it can significantly impair the defense of that claim. What it does is it opens the door for the claimant to say certain communications happened, which they may have not happened, or things were agreed to that weren't agreed to, or the scope had changed, or skew events in a way that favors them. So it gives them that opening. And it also will call into question your judgment and your conclusions without the documentation and whether you complied with the standard of care. No documentation will also basically evolve or create a situation where a claim becomes a swearing contest. And when I mean a swearing contest, I don't mean hurling profanities at each other, but I've seen that in claims. It's where one party is swearing that something occurred under oath as opposed to it didn't occur. And the problem with that is what our experience has been is that jurors usually will be more sympathetic to the client rather than professional. And it's even more the case in situations where you don't have documentation, because then they question your professionalism. They question your thoroughness. So it is a significant loss driver of claims in an important area that we always stress when we're providing risk advice to clients.
And I
You
know
never want that plaintiff attorney to insert their own words or their own story in place of yours.
from a quality standpoint, we have an initiative called the Enhancing Audit Quality Program. And one of the taglines was, if it wasn't documented, it wasn't done. And I think that applies to both audit, tax, advisory, all of the services that you're providing. If it's not documented, it's not done.
Without question, every service could benefit from proper documentation, no matter what it is.
Yeah, makes sense. So we've got some do's and don'ts that you were going to share with us. So let's start with the do's. What's the right thing to do?
Sure. And I think when we talk about documentation, it's important to understand that documentation includes not just what's in your work papers. It also includes all the other ancillary documentation that you create as part of providing services and operating in the electronic environment that we do. So from a work paper perspective, we always say that your documentation should tell a story, and all components of your documentation should tell the same story. So from what you were engaged to deliver, what you were engaged to do, that's the engagement letter, through the how you did it, that's your work papers, and then what was the result of what you did, what was the conclusion you reached or the deliverable, and all those end-to-end pieces of documentation should tell that consistent story throughout, and that's probably the first and primary documentation due. But then there's those other things that are great from a documentation perspective, and that's if you get a phone call from a client with a quick question, that kind of ad hoc advice that we always tend to receive, and questions from clients, advice that we give, that good documentation is that follow-up email to summarize the quick conversation that you had, that if you were providing advice, to warn the client that it's based on just the limited discussion and it may warrant additional analysis before the client takes that advice and makes a decision. That's an example of good documentation that's kind of independent of an engagement. The other things, like important client conversations that you might have, or decisions that are made on positions on a return, assumptions, anything outside of scope items, all those things that we've probably talked about, in client acceptance and other engagement letters and other aspects. Those are all elements of documentation that really should help to tell your story instead of letting somebody else do it for you.
Those are great points. So what are some of the don'ts? What should we not be doing?
Yeah, I think one of the primary things that I wanted to address here is don't assume that documentation is only your work papers. Generally, in any sort of civil case, so a professional liability claim will involve civil litigation sometimes, if suits filed. anything that could potentially lead to admissible evidence at trial is discoverable. It may not be admissible at trial, but as long as it could lead to admissible evidence at trial, it's fair game. So that's a pretty broad standard. So keep in mind that it's not just your work papers, it's emails, it's texts, it's social media posts, it's even chat in platforms like Teams or Zoom or WebEx. All these things are potentially discoverable. And it could be on your business device or account, or it can be on your personal device or account. Like I said, it is when I practiced for many years before I got into risk and claims, and we would ask for everything. And sometimes we'd get slapped on the wrist by a judge. It's a fishing expedition, or you don't really need that. But the perception from most attorneys, it was fair game. Another thing you have to be aware is there is some potential personal liability. And what I mean by that is poor documentation can result in fines or sanctions by the IRS, by the SEC, by the PCAOB, by disciplinary boards. So be careful in terms of documentation. Another point that I want to make is don't, whatever you do, make disparaging or off-color remarks in contemporaneous notes, whether those are, like I said, emails or texts or things of that nature. Either off-color or disparaging comments about the client, the work product, your partners or employees. There have been many claims, and Sarah can attest to this, where what was seemingly a defensible claim based upon the work papers was significantly undermined because of some contemporaneous email communication that looked unprofessional, that maybe was off color. And again, when documentation becomes an issue, it becomes a lot of times a credibility contest between the parties. And when you're using language like that, there's an inference that you're lacking professionalism. There's an inference that you're not performing in the way that you were supposed to perform. So keep it in mind that it goes beyond the work papers, and stay off of making any sort of unsolicited opinions about anybody or anything or the specific work product.
Sarah, we've only got a couple of minutes left, but anything you want to add on this one?
I think from a claim perspective, defense counsel is very resistant to take a claim to trial or push it when there's disparaging information in some of the documentation. It usually comes up in emails or Teams chats or other things like that, which you don't necessarily, we're human. We don't always put the same level of diligence and rigor in some of these more casual means of communication than we do in other things. So, for example, you may be chatting back and forth with your colleagues right now saying, geez, Stan and Sarah, they're telling me to do all these things and I have to work and documentation, it just takes too long. That's probably okay to say, we understand, but you probably don't want to, chat back and forth with maybe members of an engagement team and complain about a certain client that you're working on and how maybe the controller is incompetent, or complain about a manager that you're working for because they're just, it's just not your favorite person to work for. Those kinds of things, while seemingly innocent, those kind of things can be taken out of context and really just make you look bad. So just a definite word of warning there.
And think about whether or not what you're putting in writing or in a text is something that you want shown up on a big, humongous screen in front of a courtroom. Yes. Or what would your parents think? Yeah. Totally. So I know that we're short on time, but we have a hot topic, and let's go ahead and just hit it quickly while we bring the others back up for open forum, because this is a really important topic around those artificial intelligence tools that are transcribing conversations that you're having on Zoom or on Teams or something like that. You've got some concerns about that. And I just want to jump to maybe if we could just pick one or two of those risk management tips, and then we'll schedule some more time for us to go through the full slate of why we're concerned about it.
Sure. Yeah, you want to hit it brief? You want to go, or you want me to? I don't care.
Well, yeah, I can cover them. I think the one thing one specific thing, Lisa, is to understand the law. Some states have one party consent. Other parties have consent of all the parties. The majority of states are one party consent states. So know the law. You certainly don't want to be breaking the law by recording, not telling individuals, and that can be a problem. The other thing is accuracy. I think accuracy is important. Some of these transcription services, because of dialects, crosstalk, conversations that again kind of go on and on and on, and there's crosstalk. There isn't an accurate reflection of what's being transcribed. So going back and summarizing it, and making sure that it's accurate, is critical. I think those would be the two main points in the risk management that I would suggest. Sarah, I don't know if we have time. If you want,
I agree. I mean, again, it's extra documentation that's being created, which can be beneficial and help support a conversation you might have had with, say, a client. But you want to make sure that extra documentation that's being generated is actually accurate. And if there's to-do lists or other things that are on it, make sure you actually do them.
Thank you. All right, Eric. I've seen lots of questions coming in. Anything in an open forum?
Oh, we got plenty in open forum. So you've got these additional resources, Lisa. You want to highlight these, and then we can bring Mark up as well.
Yeah, we just wanted to make sure that you knew about some of the great articles that Aon and CNA produce for us around these particular risk topics. So just make sure that you're checking those out.
Okay, well, I will come. There are lots of questions on that last segment, but we'll give you a breather, and I'll go a question to Mark. Mark, a lot of questions or comments related to the Supreme Court Chevron decision. One is like, could Congress, write legislation defining various agencies with broad authority? And then there's also lots of comments, Mark, just on a little bit of frustration that the courts are handcuffing some of these agencies to do the work that they're charged with.
Yeah, I mean, I think they're both, valid points. There will be a difference in the way that legislation is drafted. The issue is where it was ambiguous. Previously, the courts would throw it to the agency, or they would defer to the agency when it was ambiguous. And so, to the extent it's drafted specifically and targeted, they're going to be able to work around that. I think that the frustration was with the courts was that there was no congressional intent, and so you couldn't prove that what ultimately an agency moved forward to do was connected to the congressional intent. And so they just need to narrow that gap. But it is going to create challenges. There will definitely be court challenges, and the agencies they don't have the same tools that they did yesterday, or when it passed, in order to defend their interpretations.
Well, thanks, Mark. We are kind of in the lightning round now. Lisa, just regarding the last segment, there were a number of questions related to how long documentation should be kept. I have ongoing clients that I've supported for 10 to 15 years. Should all of these emails, engagement letters over time be kept?
I'll take that one. So anything that has an ongoing relevance to your engagement should be with the engagement file. So if you need if you establish an NOL in a particular year, you'd want to keep the documentation of how that NOL was established for any year that was relevant. And then the retention period beyond when the services were delivered, that is going to depend on the laws in your state. Different states have different statute of limitations periods, which is the time that someone can have to bring a claim against you and your firm. So that is something you'd want to check into to see what's relevant in your jurisdiction. There's no one size fits all, unfortunately.
Okay. Well, thank
you. Can I give a real quick BOI plug, and then we can, if you want to move into closing, I can talk while we're doing that.
Yep.
I've seen some questions.
Thanks, Sarah, Stan, and Mark. Great input today. Look forward to having you on a town hall soon.
Sorry to rush you off.
Yes.
So we've gotten some questions about a BOI update. And if you go back to the August 1st town hall, We had an in-depth update with Melanie Lauritsen on that. And of course, Mark hit on some of the possibilities around possible extension. But Melanie will be on the next town hall, and she'll be giving a preview of expiring tax provisions in 2025 and what that could look like. And I'm sure she'll be hitting on BOI as well.
Okay, thanks, Lisa. So just highlighting that Marcy is actually going to be at the Bank and Savings Institution and Credit Union Conference on September 9th to 11th. And a lot of great comments about Marcy. We will have Marcy back. Maybe we'll bring her back after the Fed announcement on the 18th to kind of unpack that further. Here's some additional resources related to supporting your clients through this growing client advisory services area. So good webinar coming up, blog, newsletters, good resources for you to take advantage of. We now do have the AICPA Town Hall rebroadcast, so you can take advantage of that. Here's how to register for the next rebroadcast. And we will be having our next town hall on September 12th. Here's the lineup. Lisa was just referencing Melanie's section, which will be covering some hot tax topics as well as BOI. So Lisa, let's sign off and wish the town hall community a wonderful Labor Day weekend. It's an honor to be with you, and I hope you've all had a good summer, and we look forward to being with you for a busy fall. Lisa? Thanks,
everybody, and we'll see you in a few weeks.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.